Hi, it's a brand new day and it's a brand new month. Welcome to the August Equity Outlook presented by Centrum. I'm Manish Jain, the head of fund management, and I shall be talking about a couple of very important things that continue to plague the equity markets in India. As you know, the markets at around 24,800 or thereabouts have been stagnant for a few weeks now. And there seems to be a couple of concerns that are emerging in the market, which kind of are holding back the rally that we had all anticipated. The first and the foremost thing which is there on everybody's mind is the tariff, right? The US tariff announcement that came out a couple of weeks ago, where President Trump talked about a 25% tariff plus a penalty on India. Now, my sense here is that we do not need to be too much worried about it, and I think too much is being read into it, primarily because of three very important reasons. One is that the semantics or the details of it are yet not being disclosed. So, whether pharma is in, whether pharma is out, you don't know, right? What does the Russia penalty mean? You don't know. So, these are the things that are yet to be spelled out in greater details. And remember, India US negotiations continue to happen parallelly. So I wouldn't read too much into this unilateral announcement that has come through. This could very well be the pressure tactics which US has known, to bring into play whenever the negotiations are almost about to close. So I think we'll wait for a formal announcement on that. But having said that, I do believe that between India and China, the duty structure for towards India is going to be a little more favorable. So sectors like electronics, etc., ideally should not be impacted too much. And for logical reasons, pharma should be out of it. So overall, with 2% of GDP as a trade balance between India and US, I wouldn't worry too much about it. That's point number one. Point number two, the results season, which is unfolding as we are speaking. I think the results have largely been in line with expectations. There has really not been too much of a surprise. A little bit of a margin tailwind continues because inflation has been as benign as it has been. Crude oil prices have been as soft as they are. I think the sense we are getting over here is that probably by Q2, maybe by Q3, sectors like, for example, IT and banks will kind of settle down. And the tailwind in these sectors should kind of start very, very soon. But overall, looking at a 12% sort of earnings growth from Nifty this year and in FY27 should not ideally be too much of a difficulty. And you combine that along with a 16% ROE that the equity markets are making at 21 times or thereabouts, I don't think we are too expensive yet. And from a bottom up perspective, there are a lot of opportunities that continue to exist in the equity markets today. So I'd look at domestic consumption driven sectors, especially on the discretionary side. I'd look at hotels, I'd look at hospitals, maybe even auto, banks, NBFCs. These are the sectors where it's absolutely the correct time to start building up a little bit of a position. And one sector which has seen a little bit of a correction where I'll kind of a little bit stay away from is going to be FMCG, where I think the valuation mismatch still continues to exist, far too expensive for our taste at this moment. Third and the last most important thing is consumption. Now, there has been a very concerted effort from both the government and Reserve Bank of India to try and push consumption very heavily because that is going to be the driving factor for the economy going forward, right? Now, we've already seen a very surprising CRR cut. We've seen liquidity injection into the system. We've seen overall rate cut by 100 basis points. I think we should see at least 50 basis points more. You saw the tax rate cuts, which injected about 1 lakh crores into the disposable income in the hands of the consumers. I think the whole thing is now starting to come together, the monetary policy and the fiscal policy to drive consumption. And I think we're just about there at the brink of it, cusp of it. Both the rural as well as urban consumption seem to have well settled down now and are ready to take off, and which is going to be one of the driving factors in the second half of FY26 to drive Nifty earnings growth. So my sense here is that do not worry too much, do not read in too much into things which are essentially noise. Focus on business fundamentals, focus on domestic consumption driven strategies. Buy now from a 2 to 3 year perspective, even if the multiples stay where they are. Even if they stay where they are, you're still going to witness a double digit return, CAGR, for the next 3 years from equities. So happy investing.